This is the Weekly Outlook. Thanks for joining us at xm.com. Important data coming up, and markets will be eyeing the U.S. inflation report as to gauge the Fed's next policy move. Whereas in the United Kingdom, markets are debating whether the Bank of England will deliver a double or triple rate hike. I'm Christina Marujos. Helping me unfold this week ahead is our senior investment analyst, Marios Hadjikyriacos. Marios, let's start by having a look at the United States. Inflation for August is anticipated to have moderated slightly lower. What could this mean for Fed tightening, though, and of course the dollar?
Hello, Christina. So inflation is expected to have moderated a little bit. That's supported from a variety of factors. We've seen gasoline prices continue to slide during the month. We've seen business surveys from S&P Global saying that service sector companies raised their selling prices at the slowest pace in 1.5 years. So it seems like inflation is cooling down in the US, but is that really a game changer for the Fed? Not yet is the brief answer. So this week we heard from the Fed's second in command, Lyle Brainerd, and she said that it would take several months of low inflation readings before they become confident that inflation is moving down towards 2%. So what does all of this mean for the dollar? We've seen the dollar really go on a rampage this year. It's the best performing currency by far. It's the best performing asset, in fact, in any asset class. And this really boils down to this sort of perfect wave of widening interest rate differentials with the Fed raising rates faster than everyone else, safe haven flows with what's happening in Europe and China, and an absence of alternatives, really, because no other major currency is attractive at this point. So even if we get a disappointing inflation print from America next week, yes, we might see the dollar pull back a little bit. The markets might start flirting with a 0.5 percentage point rate increase from the Fed this month. And, we could see a slight weakness in the dollar, but I believe that it's unlikely to change the overall trend. It's difficult to envision a trend reversal in the dollar as long as Europe is suffering its energy shortage, the yen is in free fall, and China's property crisis keeps deepening.
Let's also turn to the United Kingdom now, because the passing of Queen Elizabeth has sent shockwaves of sadness. However, it is a crucial week for the region as the Bank of England is expected to deliver a rate hike and markets are leaning towards a double one. But what could the market reaction be for sterling, especially in an environment where it appears to react mostly to moves in stocks?
Yeah, you hit it right on the head, Christina. So the markets right now are leaning towards a 0.5 point move from the Bank of England. So the probability for that is 65%. And there's another 35% chance for a bigger move, 0.75 percentage point. So it's really a tough choice for the Bank of England. So on the one hand, you've got business surveys. Those are pointing to an economy that is contracting. Demand is crumbling as under the weight of the cost of living crisis. And along with the government's plan, we've heard from the new government lately, they are planning to put a cap on energy prices. Now that means that inflation will probably peak at a lower level. The Bank of England, in its latest forecasts, envisioned inflation peaking at 13% this year from around 10% right now. Since the government is going to put a cap on energy prices, it looks like that peak is going to be lower. So that also argues for a smaller move from the Bank of England, for a 0.5 point move. Now, the problem with that, of course, is the exchange rate. We've seen sterling already depreciate dramatically this year. It is outperforming only the Japanese yen, which has collapsed completely. And if the Bank of England goes for the smaller rate increase, it would invite further weakness in sterling, and that, of course, could exacerbate inflationary pressures. So there's a trade-off there. They're going to have to choose their poison, in a sense. I think the market is right. They're probably going to go for the smaller move, but there is a flurry of data releases ahead of the Bank of England decision next week that will help the market make up its mind. Now, as far as sterling is concerned, I think the most important variable by far is what you mentioned earlier, it's stock markets. We've seen the pound trade in lockstep with the S&P 500 for most of this year. And the reason, of course, for that is the UK's twin deficits. Now, moving forward, I think that the outlook for sterling looks negative because the outlook for stocks looks negative. The Fed is hell-bent to keep interest rates high. The pace of quantitative tightening doubled up last week. Valuations are not cheap, and we might see earnings downgrades if Europe and China continue to roll over.
Marius, thanks for joining me today. This was the Weekly Outlook here at XM.com.